The real question is, can they execute? Can they hit Q4 profitability while fighting this legal battle? Can they maintain momentum next year when purchase incentives disappear? And zooming out even further, this case is likely to be studied in business school because it's asking fundamental questions like, when you innovate faster than regulations can adapt, who's responsible for defining the rules? How much interpretation is acceptable before it becomes regulation? I don't have all the answers, but what I do know is that with roughly 70 days left in Q4, William Lee is treating this like the Super Bowl. William Lee is treating this like Game 7 in the NBA. Every day counts, no one can slack off, and they're in execution mode. What's going on, everyone? My name's Obi, and welcome back to Courtside Financial, podcast where we talk about business and technology. Today is Monday, October 20th, and man, do we have to talk about something crazy that just went down. Now, before we dive in, let me set the stage. I'm a NIO bull. As you guys know, I've been riding this company through the highs and lows, but what I'm not going to do on this channel is blow smoke. What happened this week isn't just a random hit piece or some Twitter FUD. If you're invested in NIO and you care about how innovative business models clash with old school accounting principles, you need to understand what's actually happening here. So we talked about this last week. We had a whole episode dedicated to this, and just before we get into it, my position on this matter was NIO has been traded on multiple stock exchanges, from New York to Hong Kong, etc. So obviously that comes with a lot of regulators, and I feel personally this could be true, this may not be true. If NIO was doing something fishy, they would have already been caught or exposed by now. NIO goes under enough scrutiny being the company that they are, and thus far nothing has come out against them that was actually baseful. All the claims so far have been baseless. Anyways, for those of you who didn't watch last week, picture this. It's October 16th and NIO is trading across 3 exchanges: Hong Kong, Singapore, and New York. And suddenly it's a bloodbath. Hong Kong shares crater 13% intraday, hitting 47 Hong Kong dollars, and Singapore is down 13.8%, and the US is down over 6%. We're talking about billions of dollars in market cap cratering in hours. Literally hours. Now, as someone who's been with NIO for a long time, my first instinct was, what now? Another short seller report, supply chain issue? None of those. This was something I genuinely didn't see coming. GIC, private limited, as we discussed in last week's video, Singapore's sovereign wealth fund, managing somewhere between 800 billion and 936 billion. They filed a securities fraud lawsuit against NIO in the US District Court. Not some activist hedge fund, not some anonymous short seller, a sovereign wealth fund. These are the most conservative, long-term, we're managing the nation's retirement money type of investors you can imagine. And here's the kicker. This is the first time a major sovereign wealth fund has ever sued a Chinese company publicly listed in the US. That's not just a lawsuit. That's a historical moment, and not the good kind. The defendants aren't even just NIO, the company itself. They've got William Lee, the chairman and CEO, listed out in the lawsuit, and they've also got NIO's former CFO. When they list individuals, they're not just calling out names, they're clearly sending a message. Now, before you panic, here's where it gets interesting. NIO immediately called out that this case isn't new. It stems from a Grizzly Research short seller report that started in June 2022. As I brought up in the last video, that's over 3 years ago. So why are they panicking now? Well, between 2020 and 2022, GIC bought about 54.45 million depository shares, which they claim they bought at artificially inflated prices and suffered severely significant losses. And they've been sitting on this watching, calculating. This lawsuit was actually filed back in August 2025, but this actually hit the news cycle pretty hard last week. A judge has temporarily paused GIC's case pending the outcomes of a lawsuit from 2022 with the same allegations. So we're in a holding pattern, but the damage to the sentiment is already done. Alright, so let's get into the meat and potatoes of this, because this is where things get fascinating from a business perspective. The entire lawsuit centers around battery as a service. If you've been following NIO, you know that this is their signature innovation. You buy the car body, you lease the battery monthly, it drops the overall cost of initially getting into the vehicle, making it more accessible to many, to a broader market. Brilliant marketing, innovative model, but an accounting nightmare. Here's the flow. NIO sells the batteries to their subsidiary Maraudery, their battery asset company, which is a separate entity of NIO that they co-founded in 2020 with partners like CATL and Gutai Junan International. NIO owns about 19.8% of Maraudery. Maraudery then leases those batteries to end consumers who pay monthly subscription fees. So here's the billion-dollar question, and the question that's going to determine the outcome of everything at stake. When does NIO recognize the revenue for selling batteries to Maraudery? NIO's position: we sell the batteries, ownership transferred, we've covered our obligation, we recognize the revenue now, all at once. Standard accounting, right? GIC and Grizzly's position: hold up, you own 19.8% of Maraudery. You founded Maraudery. You have significant influence. This is essentially a related party transaction. You can't book all of that future subscription revenue up front. You need to recognize it gradually as customers actually pay their monthly fees over several years. The Grizzly report from 2022 estimated that in Q1 2021 alone, NIO front-loaded approximately 1.147 billion ren in revenue that should have been spread over 7 years. That's massive. And they claim this artificially improved NIO's reported net loss for the fiscal year of 2021, which was around 3.02 billion ren. Grizzly even titled their report using Valiant Pharmaceuticals as the comparison, which I discussed last week, is a company that got destroyed after a financial scandal involving affiliated entities. Just brutal. When that report dropped in June 2022, NIO's stock tanked over 7% in 2 days. NIO fired back hard though, calling their reports worthless and filled with false information. They formed a special committee of independent directors, hired an international law firm and forensic accountants, did a full internal review, and in August 2022 concluded that all the allegations were not substantiated. Major Wall Street banks, Morgan Stanley, Deutsche Bank, they backed up NIO, saying that Grizzly fundamentally misunderstood the battery as a service business model. Here's what keeps me up at night though, and matters, and why this matters beyond the NIO lawsuit. This lawsuit exposes a fundamental tension between regulation and innovation. Battery as a service is disruptive. It's a hardware as a service model that didn't exist when these accounting standards were created. Is NIO committing fraud, or are they operating in a gray zone where the laws are legitimately ambiguous and they can choose an aggressive but defensible interpretation? Because let's be real, if GIC wins, this doesn't just affect NIO. This sets a precedent for every company doing hardware as a service worldwide. We're talking about a case that could reshape financial reporting across industry. Now, while all this drama is happening, William Lee's doing what founders do: doubling down. On October 17th, literally the next day after the stock cratered, CEO William Lee held an internal meeting with mid to senior management. This is NIO's quarterly VAU meeting where Lee reviews vision, action, upgrade outcomes, and sets the next quarter objectives. And his message was crystal clear. Q4 profitability target, that's non-negotiable. This must happen. This is the test our entire team must pass to demonstrate our operational efficiency and business capabilities, he told employees. He emphasized this isn't for show. It's the cornerstone for long-term sustainable development. Remember, they're targeting break even on a non-GAAP basis, which excludes one-time items to contribute towards profitability. But here's where Lee shows some serious thinking. He told the team to secure as many orders as possible across all models for Q4. And this is key because the entire EV industry could experience a decline going into next year, Q1 of 2026, due to China's tax incentives expire. If we harvest more in advance this year, our operational pressure will be reduced. So it's a smart strategy, front load demand before incentives disappear. We specifically called out the all-new ES8, which they launched at NIO Day September 20th, with deliveries starting September 21st. He said demand has exceeded initial expectations and they're confident about hitting their December production target of 15,000 units. And get this, if you order an ES8 now, you're looking at April 2026 delivery. That's a 6-month backlog. That's not a company in crisis mode from a demand perspective. So what do I make of all this as someone who's bullish on NIO but staying objective? Well, here's my take. The GIC lawsuit is serious. When a sovereign wealth fund who's traditionally conservative decides that legal action is worth the reputational risk, you have to pay attention. Whether they have a case or not, the cloud of uncertainty hurts. We're seeing that in the stock price. Investor confidence takes a hit, and obviously stock volatility increases. But, and this is important, the lawsuit is about accounting interpretations from 2020 to 2022. It's backwards, but meanwhile, NIO's current operational trajectory shows a company pushing towards profitability with strong demand for its flagship SUV. The real question is, can they execute? Can they hit Q4 profitability while fighting this legal battle? Can they maintain momentum next year when purchase incentives disappear? And zooming out even further, this case is likely to be studied in business school because it's asking fundamental questions like, when you innovate faster than regulations can adapt, who's responsible for defining the rules? How much interpretation is acceptable before it becomes regulation? I don't have all the answers, but what I do know is that with roughly 70 days left in Q4, William Lee is treating this like the Super Bowl. William Lee is treating this like Game 7 in the NBA. Every day counts, no one can slack off, and they're in execution mode. Look, as a NIO bull last week hurt, I'm not going to sugarcoat it, but I'm also not going to panic. NIO, the company they were in 2020 to 2022 when these allegations happened, and there's still no proof to say that they did anything wrong, they're not the same company today. They're more mature, they're focused on profitability, and they're operationally disciplined. The lawsuit will play out in court. The regulation questions will be answered by judges and regulators, but in the meantime, NIO has cars to sell, batteries to swap, and a profitability target to hit. Stay informed, stay objective, and don't let fear make your decisions for you. That's it for this episode of the Courtside Financial Podcast. Happy Monday. This is Obi. If you found the video insightful, useful, at the very least entertaining, any of those things, make sure you hit the like button, share the video, help us reach a broader audience, and comment down below. Your engagement really does go a long way. See you in the next one. Goodbye.